So welcome everybody. This is the fourth quarter of 2021 portfolio analysis for our portfolio, Lone Star Capital. Asset manager, Josh Hoffman, Rob Beardsley, many of you probably know as well on the call. Also, if anybody has questions, we'll try to answer them as we go. We can certainly make this more interactive. I'll try and monitor the chat box, but might get wrapped up. Rob, if a question comes up, feel free to pause and we can.
Yeah, I'll monitor the chat for you, and towards the end we can let people unmute and just ask questions directly as well. So keep it interactive for a little bit of Q&A at the end.
Sure, sounds good. So jumping into a review of the fourth quarter. So we had two acquisitions. We're very excited about. First being Hollister Apartments. It's 156 units in Dickinson, which is southern Houston, southeastern. Pretty much excited about this. So essentially it was a 1974 build, but in 2018 it was rebuilt post Harvey with all premium interiors. And basically we're coming in to beautify the exterior to match premium interiors. So we're also going to round it out with the smart home package, including thermostats, smart locks, and potentially package lockers. We're also going to add washer and dryer connections to all the remaining units and install washer and dryers in addition to the connections. This is going to be a big source of other income for us. We're also going to upgrade the amenity package at the property. So that's going to include a fitness center, business center, and upgraded carport lighting as well, in addition. Next, we have Encore on the Bay. So Hollister closed in November 16th. Encore was a December close. It's a larger property, 296 units. This is, as you can, as the name implies, it's on the water. So it was a 1970 vintage. It was rebuilt in 2010 after, I believe it was Hurricane Ike. So this is a bigger value add lift for us. And I'll explain a little bit of that in the Q1 2022 preview. But basically we're very excited about both these properties. They fit right in our wheelhouse. So we had, a lot of activity going on, a lot of projects and scheduling and such. And so busy quarter. At the same time, we had our first full cycle disposition, first full cycle investment. That was Cranbrook Forest. You can see the IRRs both to the project and net investor. So 23.6 for the project, 17% for investors. It was an equity multiple about 1.69 times. This actually closed in December as well. Towards the end of December.
Yeah, on the last day of the year.
Yeah. New Year's Eve, exactly. So excited about that. And then Verandas at Bear Creek is currently under contract. We're expecting to close in Q2, likely beginning of April, sometime in there. But this is a home run. Estimated returns, 36% for the project, 30 plus for net investors, and about a 1.9x multiple as well. So be very glad to have that under our belt as well. And then this is going to, prove our track record and allow us to reach not only new investors, but perhaps some institutional capital as well to prove that our underwriting and business plans do actually work. Following up on Q4, so CapEx wise, we have two projects that are underway. The first being landing at Pinewood Park. This was post buyout in April. Since then, we've scheduled 100% of the work and 95%, this is site-wide, interior, exterior, both has been completed. The two remaining projects have been delayed due to supply chain issues and scheduling from our vendors. And so that's kind of, I'm sure everybody's heard the same thing, supply chain and everything's taking longer, supplies are more expensive. However, we actually did get some good news recently. These projects were both slated to break ground at the end of this month and then finish at the end of March. And actually the supplies for both of these final projects came in this week. And so we're going to actually be back to our original schedule. So at first we were about 3 weeks to 4 weeks delayed, and now we're back on track actually. So it appears that hopefully, knock on wood, the effects of COVID are starting to mitigate and supply chains are opening up. If you look at actual versus budget, so this is our total spend versus what we budgeted. We're currently 8% under our budget. So that's the result of quite a bit of due diligence by our property management and construction management teams. And then on Solano, so this was a property that we acquired mid-July. And the CapEx is underway. Exterior wise, we've got about 90% of the work scheduled and 70% of that has been completed. We're currently running a 22% surplus relative to our budget. And interior work, we actually have a CapEx call every Thursday. And as of this morning, interior, we have pretty much full scopes from a number of contractors, and we're going to start approving all interior work. We're still deciding the best path forward as far as if we should renovate occupied units instead of just doing it at turn. We are thinking that we are going to do some backsplashes in occupied units, which is not going to be a huge distraction or inconvenience for tenants. And then this will also further justify our rent bumps that we're instituting. And currently at the property, which we'll see in a moment, we have been instituting about $15 to $25 just rent bumps. And then on top of that, again, I'll get into it, but we're instituting a RUBS package as well, which is about $45.
Which was definitely, I mean, just to add on that, it was very unique in the Solano submarket that this property didn't already bill back for RUBS. And we analyzed the submarket, looked at the comps. It was normal for the market to be charging RUBS. So that's what gave us the confidence to implement that when it didn't previously exist at the property. And that's a great way to create additional revenue. And we've been successful doing that on previous projects as well.
Absolutely. Thanks, Rob. And then in terms of a bigger issue, again, related to COVID, personnel and maybe property management and real estate in general, turnover and issues with staffing, finding good people, keeping good people. So we have had some turnover, particularly in regards to maintenance personnel, somewhat on the leasing and not so much on the actual community manager side. But to mitigate these issues, we've expanded our property management team. So we brought on a regional property manager who's going to oversee our entire portfolio of properties and hopefully drive efficiencies across our portfolio, and then free up our VP of operations to work on some other high level items. One of which is bringing construction in-house. And so one step as a natural progression towards that was bringing on a regional maintenance manager who has been with us for quite a while. Really, really dependable, knowledgeable, great guy as well. And he's brought on to basically float between properties if they're, again, knock on wood, hopefully not any turnover, but if there is, he can easily pop in. And then if we need additional feet on the ground to install or implement our interior or exterior CapEx projects, he certainly can jump in as well and help out so that we don't have to pay additional costs to GCs and vendors and such. So very excited about bringing both these people on.
Yeah, and the regional maintenance, like Josh mentioned, alleviates some of the additional costs when you need to hire temp workers, or if you need to outsource, like Josh said, to contract work. So, bringing that in-house helps certainly with managing costs and just having more speed control, which is what we like and kind of in general alignment with our vertical integration. And the other thing to point out is, as a management company, we're very small. We only manage our own properties, and we're not looking for third-party business, and we're not even necessarily looking to be profitable. We are only running our management business to support our ownership. And so we have the luxury to not really operate our management company for profit. For how small we are and how few properties we have a really strong team with the VP of operations in Houston. We've got the regional manager, now the regional maintenance. So it's yeah, it's really fantastic for us to be able to expand and not necessarily worry about staying profitable.
Absolutely. So if we jump into our dashboard, so this is the P&L for Solano. I'm not going to go too crazy in depth on anything, but what we're really happy to see is, so we purchased Solano in July, and now our NOI is starting to creep up. We've been above our budget, but we're happy on the happy to see the positive trend upwards. Same thing with our total income. So income started to outpace our budget as well, and very excited about that. Two things that we did see, and it was in particular to verandas, another property, and also the landing. So I can show it, here it's easy to see. Utility costs really jumped up, not only relative to budget, but relative to our underwriting. So part of this in October was some unforeseen plumbing issues. So that we did, we've rectified the plumbing issues, and we are working with the city to recoup some of that lost money. This was from water expense. But in addition, the occupancy at the property, which is a good thing, has been increasing at a very rapid clip. And so from that, now the gas expense is much higher. But in addition, there's also been some seasonality in terms of just increased overall utility costs across the board. And so we're taking this information and factoring it into our underwriting going forward. Overall, we're pretty much in line relatively. I mean, you can see here operating expenses slightly above an NOI. If we look at Solano, and same thing for relative to our underwriting, we obviously compare against that as well. I'm not going to jump into that now, but our underwriting has been pretty accurate. This is a third-party budget that we do use, and we like to compare both of them just to, really keep us on target. So this is obviously updated every year, whereas underwriting is, constant from day one. But overall, really happy to see this. Personnel costs, that's been a higher budget item, a higher ticket item. But otherwise, our R&M and turn costs are pretty low. A lot of that we, is factored into CapEx budget. But overall, positive over the quarter. Here we can see all of our incoming cash flow. So this is collections here over the life of the project. So two things to note, and largely these are effects of, I believe, COVID related, but this huge jump, this was back in August. The timing of incoming payments, largely from rent relief, whether it's Texas rent relief or Baker Ripley, whatever you may have, they're not consistent. So it makes it a little bit hard to budget, or maybe not hard, but we just have to be very on top of it. You can see in December, I mean, it was record breaking, but almost, unbelievable. We collected about $300,000. Granted, some of this is prepaid rent, and some of it is collections that was coming back from money that was owed us. There was also about $16,000 one-time marketing fee from Comcast. One thing to note here, so if you look at January, this is purely a function of our accounting. So while it may look worrisome, our months end on the 25th is our accounting period. However, December year end, we end on the 31st. So January is actually just a short month, and that also explains this rapid jump, which obviously we like to see. We like to get money at the start of the month, the start of the collection period, but that's the discrepancy here, if anybody was noticing that. And so this here is showing basically apples to apples basis. This is as of the 25th. So relative to the other periods, August, September, October, still in pretty good shape. And our leasing team and property management teams have been really, really on top of collections, not only pursuing people that might be a day or two or three late, but also anybody that does need rent relief help. And so you can see here the effects of that. So our 0 to 30-day period delinquency might look worrisome and troublesome, but as you go on, the following month, basically it drops almost in half, and then 60 to 90 as well is dropping off. So we like to see that trend for sure. And that's just a function of our collection practices at the individual property level. And then just looking at the landing, similar story in terms of delinquency. It did creep up a little bit this last month, but we're working with tenants on that. And then similarly here, December, another huge month there. And January tends to start off hot and then lag a little bit. But that's purely, again, a function of our accounting periods. So normally we have about 30 to 31 days per collection period, but at the start of the year, there's only 25. If we look at our occupancy, this chart on the bottom might be a little overwhelming. This is Solano. The occupancy might look worrisome as well. However, this was not unexpected. This is purely us turning the property, turning our tenant base. And many of these renters that we are, I don't want to say pushing out, but that are choosing to leave the property have been month-to-month renters as well. So we're excited and confident that this number is going to creep up. And with higher quality tenants, and they're going to be at higher rents, including the RUBS package that Rob was talking about, and the $15 to $25 rent premium. And those premiums are prior to any actual interior renovations being done on the second floor. And so the second floor, we are going to, as I said, completely redo all interiors and justify those rent bumps as well. But currently we're basically at market. Down here, this shows all of our unit types. So at a more granular level, the 2-bedroom by 1.5 bath might look worrisome, but it's not that worrisome because there are only 8 total units. So while it is only 75%, 6 of the 8 are full and occupied. So some of the other unit types have many more units in the count, but ultimately, again, there's a slight trail off here, but this is a function of us turning the property. At the landing, however, so we've held this for a little bit longer. The CapEx project is nearly complete. And you can see the property itself is really on an upward trajectory since last quarter. So we had to turn and release about 40 down units. And all of those came online. So this dip here was really a function of just having a larger denominator in our occupancy calculation. But since that low point, you can see we're up to about 90% as of December 21st. As of this month, I believe we're 91 or so, and close to getting up pre-leased about 94%. So our leasing team has really been, I don't want to say aggressive, but pushing occupancy, pushing a big social media campaign in terms of apartments.com. Facebook has been really huge, Google as well. So kudos to them for sure. But it's exciting that the occupancy is really consistent regardless of the size. You can see that the 2 bedrooms, for whatever reason, have typically lagged quite a bit behind the other 3 beds and 1 beds, and they're starting to creep up as well. Spoken with other people. This is Landing, which is in Lubbock, so it's a tertiary market, and have seen that this is a similar phenomenon at other properties where the 2 beds lag for whatever reason. So we are very excited to see that it's on the way up. So this might be a little overwhelming here, but we're looking at, I don't know if this is in the way. Oh, no, okay, no, you don't see the box up top. Looking at average rents. across. So this is at the landing at Pinewood Park. These are obviously the same because this is comparing property-wide. If we look into particular units, these will change. I can show that in a second. And then this just has, for a particular month, November, what happened for each individual unit type. You can see we do lag slightly behind market, but as our occupancy is increasing, we're renting these units out closer to market, and our loss to lease is slowly decreasing as well. But you can see our rent growth at the property. This is month over month, and then we have a trailing 3 months, so not quarterly, but month over the prior 3 months. And really excited about this as we are getting not only renewals, but new leases. We're instituting them at higher rents. And this is before a $40 internet charge that is not calculated as rent. This goes into our other income calculation. So if you were to add that in, if you were to add in month-to-month fees, that not that there are a ton, but there are several, that will obviously decrease the loss lease there as well.
So Josh, sorry to interrupt you. It's hard to, because the landing's going through this big reposition where we got down units, we fixed the roofs, brought the units online, leasing up. There's a lot happening at the property. So it's hard to see and tease out what is growth coming from the market being strong versus our business plan, right? But it looks like from this rent growth that the property is experiencing double-digit annualized rent growth, right?
Right.
And do we have a sense for how much of that is from us versus the market?
Yeah, so the market generally is, we updated our rents in September. So most of the market growth was captured in September, October. November, December, and going forward is us catching up to market. If we look at Solano, so it's a different scenario here because we're in a different stage of the business plan. And not totally worrisome. Again, this is a function of vacancy and occupancy. So as we're bringing on new tenants, these are obviously going to keep increasing, but month over the trailing 3 months, we still have positive growth. And if we look at particular unit types, definitely certain unit types are outperforming others. So with our 1 beds, these are really, really popular. So not only are we having bumps on our renewals, but our new leases as well. And as I said, these are about $25 bumps on new leases and $15 bumps on renewals. And this is before the $45 RUBS package. Similarly, other 1 beds, strong performance. If you look at 2 beds, similar November, there was some turnover. 2 bed again in November, month over month. But ultimately, we believe that as we roll out our business plan and continue to implement the improvements and amenities at the property, that our rent growth will increase and the loss to lease will decrease. So this is a marketing slide and looking at also new leases versus renewals. This is Solano. Again, this curve looks very dramatic, but the scale, might be a little deceptive. However, the important thing to look at here is the renewal percentage. So we're at 82% on a given month, 74%, 57%. We're really capturing a lot of renewals and pushing them to the tenants that want them. The tenants that are leaving, some of them just weren't going to stick around anyway, but the rent increase might be a little much for them, or they want to go elsewhere, which is fine. This is showing our leasing, so showing the applications to actual leases, and our leasing percentage leases to applications, 44%, 75%, 90%. So we're really targeting higher quality, higher qualified tenants. And so that is improving our ratio there, where we're not just having people fill out applications that are not going to get approved. So it's making the property that much stronger. And then you can see in terms of just marketing, overall, it continues to be Facebook's huge for us, apartments.com, drive-bys. So we're getting viewings and interest from a number of sources, but social media and online presence continues to lead. Same thing for the landing. And you can see here another positive trend that we'd like to see. The brown sections are resident referrals. So as that continues to increase, we know that the property is more well regarded among our tenants. Nobody's going to refer somebody to the property if they're not happy, despite the bonus. We do offer resident referral bonuses. However, nobody's going to sign the lease if they're not totally happy. And then here, again, occupancy is on the way up. We're capturing increasing amounts, at least here, of renewals as well, and focusing on well-qualified tenants. So moving forward, this quarter, I know we're already halfway done almost with it, but we have 2 acquisitions that should be closing soon. So the first is Park at Champion Forest. It is 232 units. And this is in Houston. It's 2000 vintage, closing in February, actually, hopefully later next week. And then Broadstone Briar Forest, we just went under contract at. This is going to close likely Q2 2022. So it's 340 units. This is our largest project to date. But we're quite confident in our ability. And then Park at Champion Forest is the newest vintage that we've tackled as well. So a little bit of a different business plan. It's still value add, still class B, B minus, B. But so natural progressions for us as a company. If we look at CapEx and our actual implementation of our business plans, we have 2 that will be starting coming up this quarter. So the first, as I mentioned before, Hollister and Encore on the Bay. So Hollister, we have about a $500,000 CapEx plan, and it's pretty much evenly split between interior and exterior. It's about 60% exterior, 40% interior. Encore on the Bay, however, is roughly $2 million or so, and it's about a $2,000 per door, I want to say, cost. And so there we're going to be renovating pretty much the entire property, interior, exterior. There's a beautiful bay and dock as well. And so these we've begun scheduling, soliciting bids, and really looking forward to implementing these and capturing the rent premiums associated. And then lastly, just on a company level, we're rolling out several new tech platforms. So first is Juniper Square. This is going to be our investment management software and portal. So we're really excited about this. It has a really robust reporting and onboarding process for us, and feel that it's going to be really helpful and easy for our investors. We've heard great things from both retail and institutional investors. So we're very excited about that. We should be migrating later this month, and we'll be rolling it out for our new offerings. And lastly, we have a complete revamp of our website, and we're very excited about that. That's going to have not only links to all of our case studies, but special events that we're hosting as well. And really, really excited about that. Just some new photos, new additions for our company. So I know I kind of kept that pretty quick, but yeah, I wanted to open up for questions, maybe go that way.
Yeah, feel free to put questions in the chat, or if you want to unmute yourself, happy to do that as well.
Oh, thanks for your help in the chat box, Rob.
Yeah, no problem. Some good questions definitely came in.
Yeah, absolutely.
Yeah, and why don't we talk about the dashboard itself, right? We kind of, let's talk about what people are seeing here and what the future plans for this is.
Yeah, so we really want to expand this not only for on the asset management side, but the property management side as well, so that they can track and push leasing, LASL across the board, use it for our reporting as well. So tracking versus underwriting versus CapEx, and really have a finger on the pulse. We are waiting. So we use Resman as our property management software, and looking forward to a rollout from them for an API so that we can connect to them and have pretty much, on the minute or daily feeds so that we can have very up-to-date information. But ultimately, this is really going to be what we use to make informed asset management decisions. And then also make sure that our business plans are on track in relation to our underwriting and overall plan.
And so currently right now we have the two data sets in the dashboard, right? The landing and Solano.
Right.
But obviously moving forward, we'll be implementing it across the entire portfolio. We'll be able to have aggregate data for the whole portfolio and subsections of it, and of course, individual properties. So what is the process and timeline for that?
Yeah, so as the properties are rolled out on Resman, then we're able to add them on. So basically, there's maybe a month or two lag, and it should be decreasing in terms of the time of onboarding, getting everything set up, and then going through data validation, making sure everything is importing and tracking correctly. But yeah, after we've acquired a deal, documents have all been signed, transfer and takeover is in place, then going forward, we should be able to quickly implement these, maybe a month, and going forward, even less of a turnaround. Once we do have the API, which is slated, Resman's told us Q2, Q3. Once we have that, then it's even more simple, essentially just connecting. And I don't want to make it sound too easy, but essentially turning it on with a couple flicks of the wrist.
Awesome. All right, cool. That's all the questions I had, and if there's no more questions, then we'll just sign off. Thank you so much for being here. I know our the counterpart webinar is our acquisitions webinar with Charles, and everyone's always excited about acquisitions, but the portfolio is really where you see a lot of behind the scenes and you can learn a lot. And if you do it right, your portfolio data informs your acquisitions informs your portfolio. And so we're always learning both ways. So thanks again for being on, and we'll see you on the next one.
Thank you, everyone.